Welcome to the webinar, everyone, the Bucket Plan on Demand series. Today's topic is an asset allocation strategy your clients will actually understand. So we're going to be covering the actual philosophy of bucketing and why to time segment the money based on the purpose and the time horizon of when you're going to access the assets and what the purpose of the money is. So important for not only allocating people with existing assets, but also for goal setting for younger clients to fill those buckets and prioritize what buckets to fill and when.
So as we all know, bucket planning and just bucketing money, the concept, the strategies, it's been around for a long time. If you research bucketing money, some of the early history dates back to the 1980s with Harold Evensky really pioneering a lot of the language and concepts around bucketing money. And, certainly as we kind of got through the information age, the dot-com bubble, all the way through the dot-com crash, I think it was probably a lot of individuals' first experiences of the benefits of having a bucketing philosophy, especially those who are retiring or just about to retire. Certainly taking a bucketing strategy probably created more efficiency within their overall retirement plan. And then into the mid 2000s, 2008, we certainly saw the Great Recession. And what was interesting is this whole concept of sequence of returns risk really came onto the scene. We saw in 2009 that the government suspended RMDs for the first time. And if you really think about that, required minimum distributions cause forced income. Forced income, when the market is down, creates sequence of returns risk. And so all these research reports came out talking about how to mitigate sequence of returns risk. And one of the top ways that you could mitigate sequence of returns risk is through a bucketing approach. And I think the beauty of the bucketing approach is this simplicity. Simplicity is the ultimate sophistication. There's so much sophistication in the types of retirement income plans, tying together taxes and investments and legacy planning and all these different components that we do on a day in and day out basis. But the magic is being able to simplify it for the consumer so they have the confidence and the peace of mind to buy into your recommendations. And the bucket plan is such an incredible tool to be able to simplify what we're able to do to help out our pre-retiree and retiree clients mitigate risks. And as Jason mentioned earlier, for the rest of our clients, help them actually have an asset allocation that they understand.
When I think about sequence of returns risk, and when you think about sequence of returns risk, what causes sequence of returns risks? So there's two different ways to look at this. One is, Dave, as you started to say, like forced income can cause sequence of returns risk. Requiring a steady paycheck can cause sequence of returns risk. And then ultimately, life gets in the way, right? A third component where you need to take unexpected or income or withdrawals from your assets when the market's down or your account balances are down. And that leads into the next thing is what causes sequence of returns risk? Well, it's kind of a perfect storm in your portfolio where if the market is down, obviously equities, and then you need to sell out of the portfolio, you can never make that money back. But what about the portion in bonds? Well, interest rate risk can also cause sequence of returns risk because, as we all know, as interest rates rise, bond values go down. So people think that's the safe haven in their portfolio. They'll just go to the bonds and liquidate bonds. But ultimately, what can happen is if the bonds are down, that can cause sequence of returns risk too. So how do we mitigate sequence of returns risk? It's a simple three-bucket approach: now, soon, and later, right? The now bucket everybody has. That's the money in the bank. That's the cash equivalent, right? But really it's that amount of money that you're going to be able to put your head on the pillow and sleep soundly at night. The soon bucket is that preservation bucket. It's kind of like that's the money, if you get that one set up right, that's what can mitigate sequence of returns risk, because typically it's where people go through the money in the bank or they're low on the money in the bank and now bucket, and now they got to take income or withdrawals and out of their portfolio, and they never had a portion of it set up in a vehicle or in a way that they can confidently take income or withdrawals without causing the sequence of returns risk.
I remember the first time I saw this sitting in your office, actually, and it was just such a light bulb that went off. I mean, I was so used to seeing charts and graphs and ledgers to try to illustrate asset allocation and how the whole plan came together. And to be able to see this visual on one page or on a dry erase board in one snapshot, that really painted the picture of the entire asset allocation, the now, soon, and the later. I just, immediately knew this was something that could benefit all of our clients to be able to have a plan like this in place.
Many years ago, Dave, this started out, and what I used to do is I used to write up on like a dry erase board, an electronic version, but up on the top of it, I would write retirement income plan, because most of the people I was working with were people that were pre-retirees and retirees. And so I was talking to them about segmenting their money in retirement income plan. I've been doing that since the 90s. And I used to write across the top, write a retirement income plan, and then I'd draw 3 boxes. This is before now, soon, later, or any of the other stuff you see on the screen. But I used to draw 3 boxes, and then I would draw their different accounts inside of the boxes. And then we talked about moving those accounts around. And then I'll never forget when I drew, and I typically would draw the account balances at the top of the boxes. And then as I was talking to somebody, I drew circles around those account balances. And then the client said to me, well, that kind of looks like buckets. Mm-hmm. And it's like, oh, yeah, it's a bucket plan, and that was like the early evolution of it. And then just to continue to always try to simplify it, because I think that's the biggest thing that we do as advisors is we get too smart. I mean, we do. We get too smart. We get too sophisticated. And then ultimately we lose the simplicity. It's easy to do because you start overcomplicating things. Because the more you know, the more you want to teach them, the more you want to share. And sometimes you take it out of a format that's easy to keep it simple. And that's the beauty of this 3-bucket approach, is it keeps it simple for the client. You can use it for very sophisticated clients, and you can use it for very almost financially illiterate clients that don't really, they've saved money, they've done a good job, they've worked hard, they've built up money in the 401k, they have money in the bank, but they don't really understand the basics of financial planning. And so you can use this as a tool for the everyday hardworking family and also the more sophisticated investor, because they get it. And you can back up the dump truck of data to support the behavioral finance pieces of why bucketing is such a strong approach on how to really mitigate risk and sequence of returns risk and retirement and freak out risk like we've talked about.
So let's take them through each of the 3 buckets a little bit more in detail. Talk about some of the key components. Talk about the now bucket, Jason.
Yeah, so the now bucket is, really has these 3 components you see up on the screen. But when you talk about the now bucket, one of the most important things you want to talk about, which is going to differentiate you from the rest of the advisors out there, is you actually need to counsel them that it's okay to keep more than enough money in the now bucket. See, advisors out there are greedy, and all your competitors are greedy. And what they're doing, and you know what? Pigs get fat, hogs get slaughtered. And so the thing is don't worry about, oh, well, I'm not going to make commissions or fees on the amount of money in the bank in the now bucket, so I want the least amount of money there. That's the wrong way to think about this, right? You're going to differentiate yourself by actually counseling them the other way to put a little bit more. I mean, what's an extra $10,000 or $20,000 in the now bucket if it gives them peace of mind? The key is everybody's got a magic number, and that's what you want to say to the client. Everybody's got a magic number. You have it, I have it. There's a certain amount of money that you're going to put your head on the pillow at night. And that's key terminology too, head on the pillow at night. They can visualize that. They're sleeping soundly by having enough money in the now bucket, right? And so that you want to talk to them about that component. That is their emergency or comfort fund. That's that certain amount of money that's going to make them comfortable. But then from there, you also want to have planned expenses covered. So if there's planned expenses, if there's a wedding, a roof on the house, or a once in a lifetime vacation. They're going to travel around the world, or a new kitchen or bathroom. Big expenses that are not part of their typical operating budget that they save and accumulate for. You want to talk about those, put that money aside. Don't put it at risk. Don't commit it to the sooner or the later bucket. Have that money set aside. And the third component only comes into play, income 0 to 12 months, if somebody is about to retire or already retired, and they will be drawing off of their liquid investable assets. That's the only way that third component comes into play. But if they're about to retire and they're going to be drawing 20 grand a year off liquid investable assets, put 20 grand in the bank, right? Or set it aside in a money market or whatever it is and have it just go into their checking account once a month for 12 months. And the key is you don't want to invest that money if they're going to be spending it over the next 12 months. It doesn't make sense. And so those are the three key and core components, but take the time to counsel them through the now bucket, because you're going to do something that other advisors skip that step and they try to squeeze all the blood out of the turnip and keep as little money in the now bucket as possible. But that gives them the confidence to make good decisions on the next two buckets.
And that's huge, because it just disarms them through the rest of the process. When you establish their amount of money that they want in that now bucket, they just become a bit disarmed. And that gets, it really sets the stage for the next couple buckets, the next one being the soon bucket. As Jason mentioned earlier when we were going over the philosophy of bucketing, the soon bucket is really that preservation bucket of money. This money is going to be invested to help offset inflation, but it's just going to be invested more conservatively, so that if there is a big downturn in the market, this bucket of money does not experience that full downturn. And so if you look at the two check boxes on the right-hand side and under the one-page visual, these would be sitting right underneath the bucket. But this is going to be their income or withdrawal bucket. This is going to be the bucket of money that they're going to take income or withdrawals from. And sometimes what I'll do is I'll draw arrows, an arrow going from the soon bucket into the now bucket. If they need income, reliable income through retirement, let's say $20,000 a year, and we put $200,000 in an account in the soon bucket, you might draw an arrow showing 20 grand a year going from the soon bucket to the now bucket, so that they can visually see this is the bucket of money they're going to be tapping into to provide them that reliable income through the first phase of their retirement. And we'll talk about strategies around how to produce income a little bit later. But then the second checkbox is the inflation hedge. We want to talk to our clients and prospects about cost of living increases while they're in the distribution phase, while they're going through retirement. And so we want to make sure we have a plan for that inflation hedge. And so the bucket plan and the soon bucket really becomes that preservation bucket if you're working with somebody who's just about to retire or already in retirement. But maybe you've got a younger client in your office. Maybe they're an accumulator. They're still building wealth. Well, it's still important to have a soon bucket, because they might have financial goals or opportunities that might happen sooner rather than later. Maybe they were saving for a down payment on a home. Maybe they're helping the kids with college funding, or maybe there's an opportunity to start a business or just have, basically some liquidity that's available. It's not fully tied up and invested in the market. It's still invested for growth, but just not in something that's going to experience a large amount of volatility.
The goal is really to outpace inflation, because we don't want to lose purchasing power, right? Because when there is opportunities or we need to take income or withdrawals, but it's to invest it in a way where it's not going to have the full swings of the market.
Absolutely.
Now, the third bucket is the later bucket, right? Now that we bought ourselves a time horizon and confidence between the now and the soon bucket, because we've allocated an appropriate amount of money, we can confidently invest the rest of the money in the later bucket. Because we can afford to take on risk in the ups and downs of the market, because we've bought ourselves that time horizon. Most everyone understands risk and reward. We can take on the risk for the reward in the later bucket. but we don't want to do that in the now and the soon bucket. So it's for long-term growth and legacy planning. And, people say to me, Jason, my kids are raised. I'm not worried about legacy planning. But see, legacy planning is not just for the kids. It's most importantly for the surviving spouse. Because when one spouse passes away, what happens to their income, right? Income goes down. Income almost always goes down when one spouse passes away. If they're on Social Security, they lose a check. Many cases they have a pension, they're losing a check or a check's going down. There might be supplemental income that could be happening in retirement. Whatever it is, income typically almost always goes down in retirement, but what else happens? Income taxes go up. See, a married couple filing jointly, they get double the standard deduction. All the brackets are bigger. When it's a widow, a single filer, all the brackets shrink. The standard deduction gets cut in half. If they need a similar income taxes are going to be exponentially higher for a surviving spouse. So we got to mitigate that risk. We got to protect against the fact that income goes down, taxes go up. It's a double whammy. And out in that later bucket, we got to plan so that's tax planning, that's income replacement, that's long-term care or disability. Honestly, when you ask clients and go back to the podcast and webinar we did on the most powerful questions, and when you rank their number one concerns or priorities, it's almost always running out of money, income replacement for the surviving spouse, long-term care or disability, kind of wiping out the estate. I mean, these are some of the most common things, and income taxes going up. You're talking about a lot of that in the later bucket to do that proper planning out in that later bucket.
Now, this is what we commonly see with clients when they first come in. We call this the not quite plan. And so the not quite plan is, as Jason mentioned earlier, they've got a small bucket of money in the bank, and then they've got a big bucket of money in all their investments, and it's allocated or invested like they're a long ways out from retirement, when in reality, they're right around the corner. And I just had a client, they actually just completed their planning agreement yesterday to engage and move forward with this. And this was really eye-opening for them. They had $1 million in IRAs that was all invested for long-term growth, and they're 63 and 65, and they're going to retire in the next 12 months. And then they had $200,000 in the bank right now, earning next to nothing. So those were their two primary assets, $200,000 in the bank and $1 million, 1.1 million out in IRAs in the later bucket. And when we showed them the visual of the bucket plan, they had that big aha moment for themselves as well, that they were missing this soon bucket. And they had every intention. The wife was not eligible for Social Security. The husband was. The wife was going to be a retired school teacher, and the husband was an executive at IBM. He had read everywhere that you should defer Social Security till 70. So if you think about it, they're going to have 4 or 5 years where they're going to have pretty high withdrawal rates of their portfolio to be able to defer Social Security till age 70 until that kicks on. And then at 70, their withdrawal rates will fall. But this visual, not having that soon bucket, not having any plan in place to account for that Social Security bridge that they needed, was one of the biggest motivations for them to want to hire us to move forward in helping them map out and build this plan. And when you show prospects that they have this enormous gap between where they are today and where they should be today, it incites action for them to want to move forward and hire you.
At the end of the day, this is an asset allocation strategy they can actually understand, right? I mean, if you really think about this, the now, soon, and later bucket, the now is cash or cash equivalent, right? The soon bucket is your bonds or your fixed income or your fixed income alternative, which could be a fixed annuity or bonds or CD ladders. If you're creating income, bond ladders, CD ladders, fixed annuities, basically your more fixed income or fixed income alternatives. And your later bucket is your equities, your real estate, your other holdings. I mean, this is just a way to look at it of a way those financial vehicles all fit in. It's just a way they'll actually understand it. But what it does by positioning that middle bucket, that soon bucket, in a more conservative approach or planning for the income or withdrawals that they're going to need, you can mitigate the risks of market risk and interest rate risk, which ultimately lead to sequence of returns risk. So we want to, especially for pre-retirees and retirees that are going to be drawing steady income off of their portfolios, you got to mitigate these risks in retirement. Sequence of returns risk is, in my opinion, one of the biggest dangers, which ultimately leads to longevity risk, running out of money in retirement.
And that was huge for that client I was just sharing. I mean, think about taking a higher withdrawal rate early in retirement. We're on a 10-year bull market, right? There's probably a good chance we're closer to the end than we are the beginning. And we don't have a crystal ball. We can't predict the future. But when he realized that he was going to have to take more out of his portfolio early to delay Social Security, which was the right move for him to do, it exposed him to sequence of returns risk like you couldn't believe, right? And to simply put that soon bucket right in the middle creates so much more reliability within his overall financial plan. And again, clients can visually see it when you show them this image of the bucket plan.
So they really vary, on sizes based on the needs, right? Somebody who's longer ways out from retirement, really focused on accumulating that later bucket, they can rely on their home equity line of credit primarily for the now bucket. Maybe they keep very little there because they want it all to grow for the future, and the soon and the later bucket. The soon is just for those major planned for those college expenses that might be on the horizon 5 years out, or just that opportunity bucket that we've talked about, a certain amount of money they want to make sure that isn't really focused on the long-term growth. That would be an example of, varying sizes. Somebody who is, needing retirement, like Tom Hegna talks about, really they're going into those go-go years where they want to spend a lot of money in the first phase of retirement, enjoy themselves, and figure the later buckets more their no-go years. It might look a little bit more like this.
Last but not least, these are the party time clients, right? These are the clients that tell you, hey, I want the last check I write to bounce when they're putting me into the ground. This is where maybe they're spending a lot of money right now. They're not really thinking or too worried about the future. And of course, if clients end up with a plan that looks like this, we certainly want to maybe take them through a budgeting exercise and talk to them about creating sustainable income, because we certainly don't want to put any clients in a position of having that later bucket run out before their life runs out.
But these are the fun ones to go to happy hour with.
So as Jason mentioned earlier, one of the biggest reasons to implement the bucket plan and help educate your clients on this philosophy is mitigating three of the biggest risks that exist today. Market risk. We're on a 10-year bull market. The market is at an all-time high, and a lot of people getting ready for retirement are worried about the valuation and where it's at today. Interest rate risk. Now, we went through a blip of rising interest rates, and now we're starting to see the Fed is talking about reducing them again. But I think most people would agree that we will see a continued interest rate, a rising interest rate environment over the next 3, 5, 10 years. And as interest rates rise, bond values can fall. If you're selling into the principal value of those bonds, you are subjecting your money to sequence of returns risk. And with market risk and interest rate risk, those two things together lead to sequence of returns risk.
And as I mentioned a little bit before, freak out risk, right? I mean, people make bad decisions when they basically don't have a soon bucket. When people don't have a soon bucket, they make bad decisions because they don't have the peace of mind. They have a certain amount of money in the bank. The rest of the money they look at as later bucket. And you know what? They might even have technically the holdings in their later bucket. But when you segment it out and actually position their assets, it gives them that peace of mind and that confidence to stay the course, because all they see is the account balance going down on the statement, right? They look at it as a big aggregate. But if they have a certain amount of money set aside, even if it's all lumped together in the portfolio, when you segment it out, it gives them the confidence to know, oh, I have a soon bucket. I have the now bucket. Maybe I have short duration fixed income, or I have some more stable things within my overall portfolio. But by positioning it in the soon bucket, it gives them that peace of mind.
All right, so let's talk about the next steps. You've now mastered the bucket plan philosophy. You're able to explain the now, the soon, and the later bucket with your prospects. They decide to move forward with you to become clients, and now we need to talk about implementation. Implementation of strategies that can help them succeed within the bucket plan. And probably the biggest challenge that advisors have is navigating the soon bucket. I mean, let's face it, if a client's got 10, 15, 20, 30 years to invest their money, most advisors are going to gravitate more towards market or equity-driven investments, portfolios geared for growth. But what about those clients that need to access their money sooner rather than later? They need that income. How do we stage that money, Jason?
So the first three strategies, the bridge, the floor, and the yield, are all really in a situation where you know they're going to be taking pretty steady income off their portfolios. The third, or the fourth, which is really a non-income, is just kind of that life gets in the way type of thing, right? Life happens, unexpected income or withdrawals. So the first we call the bridge strategy. So the bridge, because people can visualize a bridge, right? They get it. And really what you're doing is you're drawing down principal. Years ago, we called it spend down, and we have some clients that did not like spending down their money, right? So drawdown kind of sits with them a little better, and bridge is even better. It's buying a bridge for a time horizon out of that soon bucket to create that steady income stream. Also, if you're in a situation where you're going to do systematic Roth conversions, where you're going to have required minimum distributions, the bridge strategy is the best strategy. The bridge strategy is just basically buying a 10-year or more time horizon. Typically, we benchmark about 10 years. We're buying about a 10-year time horizon, because people know that if you buy a 10-year time horizon, the percentages are on your side that the market's going to do well over a 10-year time horizon. It's long enough time horizon. So we buy a 10-year time horizon. That's a bridge of income. The second would be if we build a lifetime floor. So build a floor of income for life out of the soon bucket. Now, some people don't have enough money to do a floor, or especially the third steady income strategy, which is portfolio income, a yield strategy, right? Think about it. If you want to build a yield, Dave, if I wanted $50,000, or that's a lot, let's say $25,000 a year, and I was able to pull a 4% yield, how much am I going to need off of the portfolio?
Right, at least $600,000 or $700,000.
Right, yeah, exactly. It's right. It would be a little over $600,000. That's a lot of money just for the soon bucket. In many cases, people don't have enough assets to do that, because it's going to leave very little in their later bucket. Now, if you were to buy, say that same person, 65 years old, and they want to buy lifetime income for a husband and wife out of the soon bucket, you know, about how much is that going to take on 25 grand a year?
Probably about 500,000, so a little bit less.
So a little bit less, right? Now, on the other hand, if somebody just wants to buy a temporary bridge, a time horizon of just 10 years out of their soon bucket to let the market do what it does, the volatility, the up and down in the later bucket, and set aside inflation thinking for a moment, but about how much would they need? $25,000 a year.
About $250,000.
Right, like half of what you would need to buy lifetime income or a floor. So there's a lot of clients that the bridge works really well, because they need to invest more money for growth out in the later bucket. Some clients have done a good enough job of saving and accumulating, they can afford to take the risk off the table and buy a lifetime income floor, or just live off of yield because they have enough money they've accumulated in the portfolio.
And what's interesting is sometimes you might find a blended strategy is the best. Maybe, as Jason mentioned earlier, they want a little bit higher income early on in retirement, but they're still conservative and they want a baseline level of expenses guaranteed for as long as they're alive. Well, maybe you guarantee the baseline expenses with the floor, and then you layer on a bridge to take them through the first 5 or 10 years of retirement to provide them higher income early on. But what about people that don't need income? That's where the non-income comes in at the bottom. Just because they don't necessarily need planned income does not mean they don't need a soon bucket, because life happens, right? Unexpected income or withdrawals. Think about times over your career where you've mapped out a perfect plan. Somebody comes in and they say, yeah, we're not going to need any withdrawals or income for at least 4, 5, 6 years. And then 2 years later, they're like, hey, we need 20 or 30 grand to help out the kids, or we had an opportunity to buy a new boat. So non-income accumulation for unexpected income or withdrawals. And if you look at kind of this spectrum that we're going to share, this just shows that, there's not always one perfect solution. It's a consultative approach of you discussing with the client which of these solutions is going to best accomplish their goals and objectives.
And again, it's all risk and return, right? I mean, everybody knows everything you see up on the screen, right? But in our opinion, right, if you're talking about the soon bucket, you want to try to counsel the clients and make sure you at least give it as options. See, what I find is too many advisors don't even give the stuff on the top of the screen as options to their clients, right? Because unfortunately, sometimes advisors, they can't justify charging a fee on those assets, or maybe they don't want to use a commissionable product or whatever it is. But at the end of the day, isn't it the client's choice? No doubt you should be advising them. You should be giving them guidance. But for some clients, if you ask them point blank, how much of your income do you want guaranteed? That should be their decision, not your decision. And so ultimately you ask that question and let that conversation play out and counsel them on what their options are to guarantee a certain amount of their income if that's what they choose to do. It doesn't mean you need to guarantee it for life. You don't have to buy an annuity with a lifetime income rider or put it into a SPIA or a DIA. But what you can do is buy a temporary bridge. You can build a CD ladder. You can build a bond ladder to buy them a certain time horizon. You can use a fixed or an indexed annuity and just do a drawdown approach where you're creating a temporary bridge to give the client the peace of mind that they can weather the storm with the soon bucket in place, to have the confidence to stay the course on all the stuff on the bottom of the screen, which are more of the later bucket assets, to the mid to the bottom.
And so on the later bucket, again, growth. So we're focused on accumulation, lifetime income. So maybe you have a client who has 10 plus years before they're going to retire, but they do want some sort of guaranteed lifetime income in their financial plan. You have the ability to buy a private pension through an insurance company. There's healthcare or confinement goals and objectives in the later bucket, with confinement benefits, chronic illness, long-term care benefits, and then last but not least, death benefit for inheritance, legacy planning, and wealth transfer. But Jason mentioned something earlier. He said giving them the peace of mind, because this chart, I think, represents what happens when investors don't have confidence. They don't have a plan in place. This is the Dalbar study through the beginning of 2009. It goes back 20 years on the growth of a $100,000 investment. So 20 years ago, even though we've been through two pretty big market corrections, if you invested $100,000 in the S&P 500 index, your $100,000 would be worth $298,000 today. That's about a 5.6% return annualized. But the average equity investor has only returned $214,000. It's cost them $84,000 of difference. Now, why does that happen?
That's huge on a $100,000 investment.
Huge.
It's cost 84 grand. Yeah.
Why does that happen? It happens because people didn't take the time to properly set up a now bucket and a soon bucket and have the peace of mind and confidence to keep the rest invested in the later bucket for long-term growth. And on the right-hand side, this is actually more astounding. This is the fixed income environment. So talk about soon bucket money. The left-hand side, later bucket money, right? Took away $84,000 from the client's later bucket. On the right-hand side, the soon bucket is fixed income, we said earlier, in terms of asset allocation our clients can understand. In the soon bucket, the Bloomberg Barclays U.S. Aggregate Index has averaged about 4.5%. 100,000 turns into 243. But the average fixed income investor, 22 basis points, because they don't have a plan in place. $138,000 difference on a $100,000 investment. This is why clients need you. They need you to help coach their behavior. And that's what has brought about this entire field of economic and behavioral sciences. So many people on this webinar realize Richard Thaler, he was an academic from the University of Chicago. Just recently, October of 2017, he wins the Nobel Prize in Economic Sciences. And he won that for his work, his groundbreaking work and research in driving this entire area of study known as behavioral economics. And think about what the bucket plan does. Yes, the bucket plan simplifies asset allocation, but the bucket plan is a behavioral tool. It helps modify bad behavior so that investors don't end up like that average equity investor or average fixed income investor from the Dalbar study that we just saw ending in December of 2018.
Now I'm going to thank Wayne Cotton. He just conducted a training for us last week for all of our advisors at our semi-annual mastermind collegium. And he threw this quote up on the screen. I'm like, I love it. I love it. And so Albert Einstein, any intelligent fool can make things more complex. It takes a touch of genius to move in the opposite direction, right? Simplicity is the ultimate sophistication, as Leonardo da Vinci would say. And so now, don't get me wrong. We've covered the philosophy with you today. We've simplified, really, this philosophy and how we position. But no, that we absolutely build a financial planning process around the philosophy of bucketing. So we are definitely doing all the data gathering in 3, 4, and 5 to be able to build a customized bucket plan for the client in 6. And there's Social Security optimization and tax planning and all those things are happening behind the scenes. But at the end of the day, simplicity is the ultimate sophistication when you're client facing.
So this webinar is part of a 3-part series. You have the webinar, there's the white paper, the origins of the bucket plan philosophy, which is going to really dive deep into a lot of the things that we spoke about today, how to leverage this and use it with your clients. Most importantly, how to simplify asset allocation for your clients to understand. And then there's a special podcast. I had the opportunity to interview my co-host today, Jason Smith. And what's unique about it is, we shared a lot of the tools today. We shared a lot of the deliverables. But what Jason is going to share is how the bucket plan has helped him scale up the J.L. Smith Group to being on track to gather over $65 million of new client assets this year. And a big part of that is by running the same systems, the same processes with every client and all their advisors within the J.L. Smith Group. So tune into that podcast if you haven't checked it out already. You'll get some great stories, one-liners, and things that you'd be able to go back to your business and use immediately with your prospects and clients.
Thanks so much for joining us, and we'll see you on next month's podcast and webinar.